Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial jargon that shapes our world. And let me tell you, Warby Parker Inc. might just need a new pair of glasses after this one. Today we are diving into Warby Parker's latest annual report, their Form 10K for the fiscal year ending the 31st of December 2025. Now, many of you know Warby Parker as the cool direct-to-consumer eyewear brand that promised stylish glasses at a fair price. They started with an online-only model, blew up the traditional eyewear industry, and now they've got over 300 physical stores. So how are they doing in the ever-changing retail and healthcare world? Let's break it down. Before we dive in, if you appreciate getting straight insights from these dense corporate reports, make sure to hit that subscribe button, and if you want to chat about these numbers and more, join our Discord community, linked in the description below. Let's start with the top line, the money coming in. For 2025, Warby Parker brought in a cool $871.9 million. That's a healthy jump from $771.3 million in 2024, showing a 13% increase. This growth seems to be fueled by opening more stores, about 47 new ones in 2025, and by customers spending a bit more per person. The average revenue per customer went up by about 6%, reaching $324 from $307 in the previous year. It looks like their higher priced glasses and lens options are actually selling. But here's where things get a little cloudy. While revenue is up, the cost to make and deliver those glasses and services jumped even faster. Cost of goods sold went up by over 16%, reaching $401.3 million. This means their gross profit, which is what is left after paying for the goods sold, only grew by about 10%, ending at $470.6 million. And that's why their gross margin, that crucial percentage showing profitability on each sale, actually dropped. It fell from a strong 55.3% in 2024 to 54% in 2025. Now, a 1.3% drop might not sound huge, but when you're talking about hundreds of millions of dollars, it adds up. The company says this is partly due to tariffs on glasses, increased sales of lower margin contact lenses, and more money spent on eye care professionals. They also mentioned higher shipping costs. Then there are the overhead costs, what they call selling, general, and administrative expenses, or SG&A. These costs cover everything else: marketing, salaries for corporate staff, and so on. These also went up by about 4.2% to $475.9 million. Now, this might seem like bad news, but get this, as a percentage of their total revenue, SG&A actually went down quite a bit, from 59.2% in 2024 to 54.6% in 2025. This indicates they are becoming more efficient at managing these costs relative to their sales growth, which is a good sign. They explained this is thanks to slower growth in corporate spending and some smart cost-saving measures, even though they did invest more in marketing. So we have rising costs and SG&A, even with better efficiency relative to sales. And that leads us to their operating loss. They reported an operating loss of $5.3 million for 2025. While that is a big improvement from the $30.1 million loss in 2024, it shows they are still not quite making money from their core business operations. Now, let's look at the bottom line, net income. After a loss of $20.4 million in 2024, they managed to squeak out a tiny profit of $1.6 million in 2025. A profit is a profit, but it is important to remember this is after all adjustments, and it's a very small margin on nearly $872 million in revenue. This is something to watch very closely. They also like to talk about something called adjusted EBITDA, which is a way to measure performance by excluding certain one-time or non-cash items. Here, adjusted EBITDA actually looks much better, growing to $95.2 million in 2025 from $73.1 million in 2024. Their adjusted EBITDA margin also improved to 10.9%. This shows that from an operational cash flow perspective, they are doing quite well. But it also highlights the impact of things like stock-based compensation and other adjustments that affect their actual net profit. What about their customers? They're proud of their growing customer base, and the numbers show it. They had 2.7 million active customers in 2025, up from 2.5 million in 2024. This is a good indicator that their brand is still resonating. Now, every company has risks, and Warby Parker lays out a lot of them. They worry about managing their growth, supply chain disruptions like that single supplier for cellulose acetate, which sounds a bit dicey, and the intense competition in the optical industry. They are also heavily reliant on their ET systems. and any cybersecurity incident could be a big problem. This is a really significant risk for them. They are very clear about how much they depend on their technology and their partners' technology. They are also embracing artificial intelligence, or AI, and they acknowledge it comes with its own set of challenges, from bias in the AI's outputs to new security risks. It is a bold move, especially with their partnership with Google, but it is not without its potential pitfalls. As they offer eye exams and other healthcare services, they are rightly concerned about the complex web of regulations they have to navigate. One misstep here could lead to serious legal trouble and hefty fines. This supplier dependency is a real concern. Relying on a few key suppliers, especially for critical components like the cellulose acetate they use for frames, is a vulnerability. If one of these suppliers has a problem, it could halt production. They mentioned sourcing half of their cellulose acetate from just one supplier. That's a concentration risk that makes you raise an eyebrow. Now, let's talk about control. Warby Parker has a multi-class stock structure, where their Class B shares have 10 times the voting power of Class A shares. This means their co-founders and co-CEOs have a lot of voting power. While this can provide stability and a clear vision, it also means public shareholders have much less say in how the company is run, which can sometimes make investors uneasy. Looking at the overall financial health, it is a mixed bag. They've turned a net loss into a small net profit, which is fantastic progress. Their adjusted EBITDA is also strong, showing their operations are generating cash. However, their gross margin has dipped, and their operating expenses, while more efficient as a percentage of sales, are still high. This tells me they are pouring money back into the business, especially into new stores and growth initiatives like AI. They also highlight the dependence on consumer spending and how economic downturns, inflation, and even global events like wars can really impact their sales. This is a pretty broad brush of risks, essentially saying if the economy tanks, so might they. And that's our deep dive into Warby Parker's 2025 annual report. What do you think about their push into AI and their expanding store footprint? Drop your thoughts in the comments below. If you found this breakdown helpful, give it a thumbs up and subscribe for more corporate secrets uncovered. And don't forget to join the Discord community linked in the description. Thanks for watching Corporate Decoder, and we'll see you next time.